In finance, an option is a contract which gives the buyer the right, but not the obligation, to buy or sell an underlying asset or instrument at a specified strike price on or before a specified date, depending on the form of the option. The strike price may be set by reference to the spot price of the underlying security or commodity on the day an option is taken out, or it may be fixed at a discount or at a premium. The seller has the corresponding obligation to fulfill the transaction, to sell or buy, if the buyer exercises the option. An option that conveys to the owner the right to buy at a specific price is referred to as a call. An option that conveys the right of the owner to sell at a specific price is referred to as a put. Both are commonly traded, but the call option is more frequently discussed. The seller may grant an option to a buyer as part of another transaction, such as a share issue or as a part of an employee incentive scheme. Otherwise, a buyer would pay a premium to the seller for the option. A call option would normally be exercised only when the strike price is below the market value of the underlying asset, while a put option would normally be exercised only when the strike price is above the market value. When an option is exercised, the cost to the buyer of the asset acquired is the strike price plus the premium, if any. When the option expiration date passes without the option being exercised, then the option expires and the buyer would forfeit the premium to the seller. In any case, the premium is income to the seller, and normally a capital loss to the buyer. The owner of an option may on-sell the option to a third party in a secondary market, in either an over-the-counter transaction or on an options exchange, depending on the option. The market price of an American-style option normally closely follows that of the underlying stock, being the difference between the market price of the stock and the strike price of the option. The actual market price of the option may vary depending on a number of factors, such as a significant option holder may need to sell the option as the expiry date is approaching and does not have the financial resources to exercise the option, or a buyer in the market is trying to amass a large option holding. The ownership of an option does not generally entitle the holder to any rights associated with the underlying asset, such as voting rights or any income from the underlying asset, such as a dividend. Historical uses of options contracts similar to options have been used since ancient times. The first reputed option buyer was the ancient Greek mathematician and philosopher Thales of Miletus. On a certain occasion, it was predicted that the season's olive harvest would be larger than usual, and during the off-season, he acquired the right to use a number of olive presses the following spring. When spring came and the olive harvest was larger than expected, he exercised his options and then rented the presses out at much higher price than he paid for his option. In London, puts and refusals first became well-known trading instruments in the 1690s during the reign of William and Mary. Privileges were options sold over the counter in 19th-century America, with both puts and calls on shares offered by specialized dealers. Their exercise price was fixed at a rounded-off market price on the day or week that the option was bought, and the expiry date was generally 3 months after purchase. They were not traded in secondary markets. In the real estate market, call options have long been used to assemble large parcels of land from separate owners, e.g., a developer pays for the right to buy several adjacent plots, but is not obligated to buy these plots and might not unless he can buy all the plots in the entire parcel. Film or theatrical producers often buy the right, but not the obligation, to dramatize a specific book or script. Lines of credit give the potential borrower the right, but not the obligation, to borrow within a specified time period. Many choices, or embedded options, have traditionally been included in bond contracts. For example, many bonds are convertible into common stock at the buyer's option, or may be called at specified prices at the issuer's option. Mortgage borrowers have long had the option to repay the loan early, which corresponds to a callable bond option. Modern stock options contracts have been known for decades. The Chicago Board Options Exchange was established in 1973, which set up a regime using standardized forms and terms and trade through a guaranteed clearinghouse. Trading activity and academic interest increased since then. Today, many options are created in a standardized form and traded through clearinghouses on regulated options exchanges, while other over-the-counter options are written as bilateral, customized contracts between a single buyer and seller, one or both of which may be a dealer or market maker. Options are part of a larger class of financial instruments known as derivative products, or simply, derivatives. Contract specifications. A financial option is a contract between two counterparties with the terms of the option specified in a term sheet. Option contracts may be quite complicated, however, at minimum, they usually contain the following specifications: whether the option holder has the right to buy or the right to sell, the quantity and class of the underlying asset, the strike price, also known as the exercise price, which is the price at which the underlying transaction will occur upon exercise, the expiration date, or expiry, which is the last date the option can be exercised, the settlement terms, for instance whether the writer must deliver the actual asset on exercise, or may simply tender the equivalent cash amount, the terms by which the option is quoted in the market to convert the quoted price into the actual premium, the total amount paid by the holder to the writer. Option trading. Forms of trading: exchange-traded options. Exchange-traded options are a class of exchange-traded derivatives. Exchange-traded options have standardized contracts and are settled through a clearinghouse with fulfillment guaranteed by the Options Clearing Corporation. Since the contracts are standardized, accurate pricing models are often available. Exchange-traded options include stock options, bond options and other interest rate options, stock market index options or, simply, index options, and options on futures contracts, callable bull-bear contract. Over-the-counter options. Over-the-counter options are traded between two private parties, and are not listed on an exchange. The terms of an OTC option are unrestricted and may be individually tailored to meet any business need. In general, the option writer is a well-capitalized institution. Option types commonly traded over-the-counter include interest rate options, currency cross-rate options, and options on swaps or swaptions. By avoiding an exchange, users of OTC options can narrowly tailor the terms of the option contract to suit individual business requirements. In addition, OTC option transactions generally do not need to be advertised to the market and face little or no regulatory requirements. However, OTC counterparties must establish credit lines with each other, and conform to each other's clearing and settlement procedures. With few exceptions, there are no secondary markets for employee stock options. These must either be exercised by the original grantee or allowed to expire. Listings and prices are tracked and can be looked up by ticker symbol. By publishing continuous, live markets for option prices, an exchange enables independent parties to engage in price discovery and execute transactions. As an intermediary to both sides of the transaction, the benefits the exchange provides to the transaction include: fulfillment of the contract is backed by the credit of the exchange, which typically has the highest rating. Counterparties remain anonymous. Enforcement of market regulation to ensure fairness and transparency, and maintenance of orderly markets, especially during fast trading conditions. Basic trades. These trades are described from the point of view of a speculator. If they're combined with other positions, they can also be used in hedging. An option contract in U.S. markets usually represents 100 shares of the underlying security. Long call. A trader who expects a stock's price to increase can buy a call option to purchase the stock at a fixed price at a later date, rather than purchase the stock outright. The cash outlay on the option is the premium. The trader would have no obligation to buy the stock, but only has the right to do so at the expiration date. The risk of loss would be limited to the premium paid, unlike the possible loss had the stock been bought outright. The holder of an American-style call option can sell his option holding at any time until the expiration date, and would consider doing so when the stock's spot price is above the exercise price, especially if he expects the price of the option to drop. By selling the option early in that situation, the trader can realize an immediate profit. Alternatively, he can exercise the option, for example, if there is no secondary market for the options, and then sell the stock, realizing a profit. A trader would make a profit if the spot price of the shares raises by more than the premium. For example, if exercise price is 100 and premium paid is 10, then if the spot price of 100 raises to only 110, the transaction is break-even, and an increase in stock price above 110 produces a profit. If the stock price at expiration is lower than the exercise price, the holder of the options at that time will let the call contract expire, and only lose the amount of the premium. Long put: a trader who expects a stock's price to decrease can buy a put option to sell the stock at a fixed price at a later date. The trader will be under no obligation to sell the stock, but only has the right to do so at the expiration date. If the stock price at expiration is below the exercise price by more than the premium paid, he will make a profit. If the stock price at expiration is above the exercise price, he will let the put contract expire and only lose the premium paid. In the transaction, the premium also plays a major role as it enhances the break-even point. For example, if exercise price is 100, premium paid is 10, then a spot price of 100 to 90 is not profitable. He would make a profit if the spot price is below 90. Short call: a trader who expects a stock's price to decrease can sell the stock short or instead sell, or write, a call. The trader selling a call has an obligation to sell the stock to the call buyer at a fixed price. If the seller does not own the stock when the option is exercised, he is obligated to purchase the stock from the market at the then market price. If the stock price decreases, the seller of the call will make a profit in the amount of the premium. If the stock price increases over the strike price by more than the amount of the premium, the seller will lose money, with the potential loss being unlimited. Short put: a trader who expects a stock's price to increase can buy the stock or instead sell, or write, a put. The trader selling a put has an obligation to buy the stock from the put buyer at a fixed price. If the stock price at expiration is above the strike price, the seller of the put will make a profit in the amount of the premium. If the stock price at expiration is below the strike price by more than the amount of the premium, the trader will lose money, with the potential loss being up to the strike price minus the premium. A benchmark index for the performance of a cash-secured short put option position is the CBOE S&P 500 Put Right Index. Option strategies combining any of the four basic kinds of option trades and the two basic kinds of stock trades allows a variety of options strategies. Simple strategies usually combine only a few trades, while more complicated strategies can combine several. Strategies are often used to engineer a particular risk profile to movements in the underlying security. For example, buying a butterfly spread allows a trader to profit if the stock price on the expiration date is near the middle exercise price, X2, and does not expose the trader to a large loss. An iron condor is a strategy that is similar to a butterfly spread, but with different strikes for the short options, offering a larger likelihood of profit but with a lower net credit compared to the butterfly spread. Selling a straddle would give a trader a greater profit than a butterfly if the final stock price is near the exercise price, but might result in a large loss. Similar to the straddle is the strangle, which is also constructed by a call and a put, but whose strikes are different, reducing the net debit of the trade, but also reducing the risk of loss in the trade. One well-known strategy is the covered call, in which a trader buys a stock and sells a call. If the stock price rises above the exercise price, the call will be exercised and the trader will get a fixed profit. If the stock price falls, the call will not be exercised, and any loss incurred to the trader will be partially offset by the premium received from selling the call. Overall, the payoffs match the payoffs from selling a put. This relationship is known as put-call parity and offers insights for financial theory. A benchmark index for the performance of a buy-right strategy is the CBOE S&P 500 Buy-Right Index. Types. Options can be classified in a few ways. According to the option rights, call options give the holder the right, but not the obligation, to buy something at a specific price for a specific time period. Put options give the holder the right, but not the obligation, to sell something at a specific price for a specific time period. According to the underlying assets, equity option, bond option, future option, index option, commodity option, currency option. Other option types. In other important class of options, particularly in the US, are employee stock options, which are awarded by a company to their employees as a form of incentive compensation. Other types of options exist in many financial contracts. For example, real estate options are often used to assemble large parcels of land, and prepayment options are usually included in mortgage loans. However, many of the valuation and risk management principles apply across all financial options. There are two more types of options, covered and naked. Option styles. Options are classified into a number of styles, the most common of which are American option, an option that may be exercised on any trading day on or before expiration. European option, an option that may only be exercised on expiry. These are often described as vanilla options. Other styles include Bermudan option, an option that may be exercised only on specified dates on or before expiration. Asian option, an option whose payoff is determined by the average underlying price over some preset time period. Barrier option, any option with the general characteristic that the underlying security's price must pass a certain level or barrier before it can be exercised. Binary option, an all-or-nothing option that pays the full amount if the underlying security meets the defined condition on expiration, otherwise it expires. Exotic option, any of a broad category of options that may include complex financial structures. Valuation overview. Options valuation is a topic of ongoing research in academic and practical finance. In basic terms, the value of an option is commonly decomposed into two parts. The first part is the intrinsic value, which is defined as the difference between the market value of the underlying and the strike price of the given option. The second part is the time value, which depends on a set of other factors which, through a multivariable, nonlinear interrelationship, reflect the discounted expected value of that difference at expiration. Although options valuation has been studied at least since the 19th century, the contemporary approach is based on the Black-Scholes model, which was first published in 1973.